John, today's question comes from Jeff. And Jeff said, loving the podcast series, The 3 Parts to a Perfect Estate Plan. Something that I was hoping to hear in part 1B, which this is interesting. I'm not sure when this inbox episode is going to air, but we do need to lay some groundwork for this before I go further into Jeff's question. So we've been doing this series called The 3 Parts to a Perfect Estate Plan. And we're still in the midst of recording this.
Right.
But we're about halfway through the 3 parts, and it's already taken us 3 episodes to get halfway through the 3 parts.
Yeah, so we're going to be, at a minimum, we're probably going to be at 6.
Yeah.
5 to 6, maybe 7.
Part 1A, and then part 1B, and then we have part 2A, part 2B. We'll see what happens to part 3. But part 1B, if you go back, that's actually the way that we have it titled. So if our listeners want to go back and listen to that, they can. Anyway, back to Jeff's question. Jeff said, something I was hoping to hear in part 1B is the use of home equity to pay for end-of-life care. Anything from tapping in home equity for in-home care to selling to pay for nursing home care. In high property value states like California, many seniors are house rich and cash poor. My 94-year-old mother owns her $750,000 home, free and clear, but has very little in savings, no retirement accounts, no pensions or annuities. Her only income is Social Security, and that puts her barely above the poverty line. Thanks for the excellent podcast, and keep them coming. Woo! Man, a $750,000 home, but no other assets and no other income except for Social Security.
Well,
I think that's the classic definition,
right,
of house rich and cash poor.
And she, they're in California, so her taxes have been frozen for her taxes are based on a previous valuation from however many decades ago, which is the only reason she can afford it.
Yep, right.
And so so you're right, Jeff. We actually didn't talk about using the home equity to pay for that. It is an option.
Yes.
Couple of things there. You've got home equity lines of credit, HELOCs, right?
Yeah.
These can be one way. It's basically turning your house into a credit card.
Right.
The nice thing about a HELOC is if you don't need the money, it's just sitting there, waiting to be taken out. Once you take it out, you, much like a credit card, you would have a small monthly payment.
Right.
Typically, at least covering the interest expense on there. The benefit of so a couple of benefits of using something like a HELOC is your monthly you're paying down the interest, so you don't end up with a compounding situation.
Right.
At mom's death, there's some debt on the property, but it's not extraordinary because you've been paying that interest along the way. And there is a relatively complicated strategy that you can get into here where, for example, let's say you pull out $1,000 in month 1, and then in month 2, it's accrued $2 worth of interest.
Mm-hmm.
So you pull out $1,002 and use the $2 to pay the interest from month 1, and then the $1,000 to live on. Right? In month 3, it's accrued $4 in interest. You pull out $1,004, use the $4 to pay the interest, and keep the $1,000.
That makes sense.
So you're taking the $1,000 every month,
right?
But you're pulling out just enough to pay off the interest from the previous balance.
Yeah.
And what that does then is you're never compounding the interest.
Yep. It keeps that loan amount at only the amount of the principal.
Right. So you get to the date of death, you have nothing but principal debt. And it's a pretty good deal. The downside is, though, you do have a payment.
Mm-hmm. Right.
So the alternative to that then is the reverse mortgage. Not terribly a big fan of reverse mortgages, in large part because they're expensive.
Mm-hmm.
The costs of the loan themselves, which they often wrap into the reverse mortgage, can be expensive. And then because you don't have to make payments on that mortgaged amount, the bank is getting the benefit of compounding interest.
Right.
And you're gonna have a much larger debt at the date of death.
Yeah.
But if you have no way of making payments, the HELOC strategy that we just talked about is too complicated for you or something like that, then maybe the reverse mortgage, might work.
Yeah.
Now he talks about his mother is 94. So everything I'm going to say after this now probably doesn't apply to her.
Well, let's go back then real quick and talk about the two options that
Okay.
we have covered, and then we can hit that. So a couple of things. On the HELOC, those are generally very expensive. And I could make the argument on paper that if you are pulling out a principal distribution to pay interest, and that's increasing the amount of the principal due, then you are, in effect, in a way, you are compounding that.
Okay.
So you can make that argument, right, on paper, that your principal amount is getting larger because that principal is going back into it, or that interest, effectively. The other thing with the reverse mortgage is, number one, they are very expensive. They are very poorly understood as well.
Mm-hmm.
I think, was it 2012, 13, something like that? That was a big, massive lawsuit from one of the federal agencies against all these reverse mortgage companies because they were out there doing effectively these predatory loans, getting people to sign up for them when they didn't understand exactly what they were doing. And to this day, they changed a few things, but they're still really complicated, and they can make sense in certain circumstances, but there are other circumstances where they don't. And this may be something you're going to get into in a moment, but if mom's 94, she does a reverse mortgage, and then has to go into care. Well, one of the triggers for a reverse mortgage being due is moving out of the home.
Right.
Right. So boom, all of a sudden, now you got another problem on your hands. And so, yeah, there's a lot of moving pieces really with both of those. The HELOC is certainly probably the easier piece. It's expensive. I think the average rates right now are around that 8%, because they are more expensive than a traditional mortgage.
Well, and on that note, especially when you're talking about transferring into long-term care, I did see an alert through some of my contacts out in the wild in the elder law community. And this was, I'm pretty sure it was related to Kansas Medicaid.
Mm-hmm.
But they were taking the position that a existing home equity line of credit was an asset in determining your eligibility for Medicaid. So where a home ordinarily would not count towards your eligibility for Medicaid, the existence of a home equity line of credit on that home was a countable asset. And so these people were having to go to the bank and cancel their lines of credit in order to qualify for Medicaid. But if you've got a balance on there, there's no way to cancel the line of credit. And you've got no way, you can't convert it to a traditional mortgage because you've got no money to pay the payments on it. And so you can run into a pickle there.
That's exactly the word I was thinking. That's a pickle.
Now, I will say, I don't know any of that for certain. This was just something that I'd seen over an email chain or something. And I think that is a totally incorrect interpretation of the Medicaid rules. And so if you're in a state that's trying to do that, I would expect somebody to challenge it at some point, because there's nothing in the Medicaid rules that would say that an open line of credit is a countable asset.
Well, if I'm thinking about this from a logical outside perspective, though, so if you sold your home and that money goes into your bank account, that is countable, right? So if you have access to that money without selling your home, I can see where they can connect those dots to say, all right, that needs to be a countable asset.
Right. But if you go down that same line, then with what you're saying, then the existence of a Visa card.
True. No, you're absolutely right.
Would also be a countable asset, right?
That's right. What's your credit limit on the Visa card?
Right. And there's nothing in the Medicaid rules that will require you to go into debt.
Right.
In order to qualify for the service, period. End of story.
Yep.
So I think that's bogus. But government rules can be bogus.
You just destroyed all of my logic. Every bit of it. It's gone. I am fully on board with your point of view now.
But here's the last thing. And again, I say this doesn't really apply to a 94-year-old probably. But if I was talking to Jeff's mom, and maybe we were having this conversation a decade ago or even longer, right? And I'm recognizing that what she has is a very valuable house,
Mm-hmm.
but also something that she may not be able to live in forever for whatever the reason, and that they might want to sell it at
Yeah.
some point. I really would have probably encouraged them to stick that home in an irrevocable trust,
Right.
where the assets of the trust would not count towards her eligibility for Medicaid. Now, doing that would impose a transfer penalty, which in California would have been 3 years.
Mm-hmm.
In most states would have been 5 years, but in California would have been 3 years.
Yeah.
But what that would have done would present an opportunity at some future point to sell the house, convert that money to cash, but the cash still be in the trust
Mm-hmm.
and not a countable asset.
Yeah.
And then, typically indirectly by, for example, Jeff pulling the money out of the trust and then using that money for mom, right? Kind of a backdoor.
Right.
But you would have access to the cash from the proceeds of the sale. This is why I often have told people, I'm like, look, I can tell you all day long that the house doesn't count against you for Medicaid, but you have to think about the situation where there's not the house is going to need to be sold.
Right. Yeah.
And so even though the house doesn't count against you, it may still make sense to put that house in something like an irrevocable trust so that you have the flexibility
Mm-hmm.
to sell the house. Or maybe like in this case, maybe Jeff lives in Idaho, right? So what they want to do is sell mom's house in California and move mom to Idaho, where she can buy a new house, which is not going to cost $750,000. So that gives her the ability then to sell the house in the trust, buy a new house in the trust, but keep the leftover equity in cash.
Interesting. Yeah.
Right. And so it just provides a lot more flexibility. Unfortunately, because of the transfer rules associated with putting assets in a trust, I wouldn't necessarily make that recommendation for a 94-year-old.
Right. Yeah.
But facts and circumstances being what they are, maybe that is right? Maybe Jeff's mom lived to 110, in which case we got time.
She's made it to 94.
So definitely some things to think about. And he's right. We didn't really talk about using the home equity to in that episode, but it is an option out there.
Yeah, it is. It is. And I think we did cover that in the episode that we did on long-term care. And we've also had a standalone episode in talking about reverse mortgages.
Yeah. So if you go back through all of our podcasts,
Yeah.
there are one or two in there where we got into the weeds on some of that.
Absolutely. Well, Jeff, thank you so much for the question. And to the rest of our listeners, if you want to ask us a question, go to bigpictureretirement.com. In the top right-hand corner, click on Ask a Question, and we'll get that there and add that to the list. All right. Thanks for listening.